Okay. Once again, hi everyone. Can you just let me know in the chat box that you can see, let me know in the chat box if you can see my screen. You can hear me loud and clear. I just need someone to confirm that you can hear me because I'm not sure if it's connected yet. Okay, thank you so much. Thank you, Nina. Thank you. I see the rest of you are shy. Okay, so thanks for confirming that everything's working fine. Okay, hi everyone. Welcome to today's session brought to you by IC Markets Global. We're gonna do a webinar on, we're gonna understand market cycles basically. Okay, so today's the 12th of May. Can you guys, I mean, other than Nina, I know the chat box is working now. Thank you, Nina. Let me know, don't be shy, where you guys are from, how long you've been trading. Talk to me in the chat box. We want this webinars to be a little bit more interactive so that it's not so dry, right, for everyone. Okay, so don't be shy, just talk to me in the chat box. If you talk to me in the chat box, it's also good because at least like I know as we go. That the chat box is still working and you guys are still hearing me loud and clear. Okay, so let's continue. Before we move on, you guys already know how this works. I think a lot of you here are regulars at the least, or you've been here. I'm a newbie trader from Nigeria. Hi, welcome to our webinar for today. Hello, hello. It's good that you're here. It means that you're putting in the time and effort to learning because to get good at anything, I think the first thing you want to do is to master the skill first. The only way you're going to get good at trading is if you master the skill first. Okay, so disclaimer again, anything that I share in this webinar should only be construed as educational. Okay, it is not any form of financial advice, investment advice. I'm not telling you to buy or sell anything. This is not a signals group. Please do not take this as me giving you any form of advice to get in or get out of the markets. Okay, other than that, a risk warning, trading Forex and CFDs carries significant risk and it's not suitable for all investors. So please be cautious when you are trading. Okay, yeah, very dangerous. Okay, so I'm gonna stay here for a minute so you guys can actually read through the disclaimer. Then we'll continue from here. Okay, cool. Okay, so I'm going to quickly introduce myself and then we can actually start on today's topic. My name is Cassandra, for those who don't already know me, right? You guys can just call me Cass. Call me whatever helps you remember. Um, New about a year. Okay, we've got a few newbies here, which is good. I'm happy you guys are in this webinar here, putting the effort to learn. Okay, I am an investment analyst and a prop trader. What that means is I spend a lot of time, and our team spend a lot of time researching, backtesting, forecasting, seeing where the markets are going. We are deep diving into the markets every single day to understand where the markets are moving. Okay, so it's very, very, how do I put this? We spend a lot of time understanding the markets, basically it. So our team, I come from Everest Fortune Group, which is a research firm based in Singapore. We have been recognized as the finalists for the best Forex and best equity research for multiple years running. Okay. On top of that, because I do spend a lot of time on the markets, if you're researching that much on the markets, I would, yes, I do spend a lot of time on it. I'm also a funded prop trader. I've been funded by multiple companies actually. So if you guys have any questions, ask me in the chat box. I'll try my best to answer you to the best of my ability. Anything at all trading related, just ask me in the chat box. Don't be shy. Okay, so agenda for today is to understand early versus late cycle market behavior, how central banks shape the cycle, positioning through different phases, and recognizing when a trend is ending. Okay, so we're gonna understand a little bit about this. It's good, especially if you are new. It gives you a different perspective of how the markets work. Okay, so let's talk about early to late cycle market behavior. Okay, so one of the most important concepts in macro and financial markets is understanding that markets do not move randomly over long periods of time. Instead, markets tend to move through cycles. Now, these cycles are not perfectly predictable and they do not repeat in identical ways every time. But structurally, there are recurring patterns in how economies, liquidity, conditions, investor behavior, and asset prices evolve over time. Okay, so I think understanding this framework is extremely important because many traders struggle not necessarily because they are, sorry, because their analysis is poor, but because they fail to recognize what type of environment they are operating in. So different market phases reward different behaviors. For example, an environment characterized by expanding liquidity, improving growth expectations, and supportive central bank policy behaves very differently from an environment where liquidity is tightening and economic uncertainty is increasing. And this affects everything: equity, currencies, bond markets, commodities, and even volatility itself. At the center of most market cycles are two major forces, okay, growth and liquidity. When growth expectations improve and liquidity conditions remain supportive, markets generally become more constructive towards risk assets. Capital flows more aggressively into equities, growth sectors, emerging markets, and higher yielding assets. As the cycle matures, however, the environment gradually changes. Inflation pressures may begin rising, central banks may start tightening policy, liquidity conditions may become less supportive, and eventually markets begin transitioning toward more defensive behavior. Now, psychologically, one challenge is that people often assume current conditions will continue indefinitely. So during strong bullish periods, investors begin believing strength will continue permanently. During difficult conditions, pessimism often becomes equally extreme, but markets are cyclical precisely because conditions evolve over time. And I think one of the key advantages of understanding cycles is that it allows traders and investors to interpret price action within a broader structural framework rather than reacting emotionally to short-term noise. Because ultimately, right, markets are not just moving based on isolated events. They are responding to shift phases within larger macroeconomic and liquidity cycles. Okay, so if you guys are confused at any point of time, stop me, just ask me a question, and I will give you some clarity or answer your questions to the best of my ability. Okay, so early cycle environments are often some of the most powerful phases in financial markets, and structurally, this is because they usually emerge after periods of weakness, uncertainty, and contraction. During these earlier phases, central banks are often still maintaining relatively accommodative policy conditions. Liquidity begins improving and financial conditions um, stabilize, and growth expectations gradually recover. So now, psychologically, sentiment during the beginning of the cycle is usually still cautious. People remain skeptical because recent negative conditions are still fresh in memory. Investors may still be positioned defensively. Economic headlines may still appear uncertain, and confidence generally takes time to rebuild. But under the surface, capital begins slowly rotating back into risk assets. This is where the markets often begin moving before the broader economy fully improves. And I think this is one of the most important things to understand about markets. Financial markets are forward-looking. Okay, they are constantly attempting to price future expectations rather than current conditions alone. So during early cycle environments, markets often begin strengthening while economic data still appears relatively weak. Why? Because investors are already anticipating improving conditions ahead. Liquidity also play a major role during this phase. So when central banks ease policy and liquidity conditions become more supportive, capital becomes more willing to move back into risk assets. Okay, credit conditions improve, borrowing costs decline, and overall market confidence gradually rebuilds. So volatility also tends to stabilize over time during healthy early cycle environments. This does not mean volatility disappears completely, but uncertainty gradually becomes less dominant compared to recovery expectations. Another important characteristics is broad participation. Early cycle rallies often involve multiple sectors and asset classes moving together because improving liquidity supports broader market participation. And psychologically, this phase is interesting because this belief often remains high initially. Many people wait for confirmation before becoming constructive again. But by the time confidence fully returns, markets may already have moved significantly. This is why understanding early cycle behavior is so valuable structurally because it helps explain why markets sometimes appear stronger when economic headlines still seem uncertain. Okay, so as cycles mature, right? Market behaviors gradually begins to change. I put an example here of what an average trader or majority of trader will go through. Okay, it starts with this is just the personal psychology of the market cycle, okay, in terms of what a trader is feeling. So they start with disbelief when the market is, they lose a little bit of hope. They see the market rallying, and then they have a little bit of hope. Optimism and belief and thrill starts to appear, followed by euphoria. And then we've got complacency. Okay, this is where things start to become very dangerous. Okay, so the market is rallying and rallying and rallying. I'll give you a very good example of this. XAU USD is a very good example of this. Okay, markets are rallying. People are buying in, people are buying at the top, and complacency kicks in. Okay. So you start seeing the markets shift. Okay. You start seeing price drop. Complacency has kicked in, and now anxiety, denial, panic, capitulation, and anger kicks in because you start losing everything back to the market, depression, and then you start again with disbelief. Okay, this is what happens with the market every single time. That's why if you are a trader, if you are a new trader, especially, trading psychology is important. That's one, but you need to know how the market works, right? You need to know how the market works so you don't end up becoming one of those people who get in at the highest high thinking there's more room to go up, but that was the highest high and then it just drops back down. Okay. You also don't want to be the kind of people where you have so much anxiety and end up not entering the market at all. So um it's just you do need to understand the markets. You need to get your mind space at the right place for you to be good at to be profitable in trading. Okay, so growth may still look healthy. Okay, asset prices may still be rising. Here, we're talking about this part. Okay, confidence may still remain elevated, but underneath the surface, conditions often begin shifting slowly. Okay, one of the biggest changes is liquidity. As economic activity strengthens and inflation pressures increase, central banks often begin tightening policy. So interest rates may rise, balance sheet expansion slow, and financial conditions gradually become less accommodative. Now, hey, these changes do not usually impact markets immediately. It usually takes time. There is often a lag between policy tightening and broader financial effects. Okay, this is why late cycle environments can sometimes continue performing well, even as underlying conditions become less supportive. But over time, sensitivity begins increasing. Markets become more reactive to economic data, inflation surprises. Sorry, I just need to write something down. I see a error message here. I'm just writing it down so that I can let IC markets know later. Okay, sorry, where was I? So volatility may begin rising more frequently and correlations between asset classes may start shifting. So another important characteristic is narrowing market leadership. During strong early cycle phases, participation is usually broad. But in later cycle conditions, performance often becomes more concentrated. Fewer sectors or assets continue driving overall market strength while broader participation weakens underneath. So, psychologically, this phase can become difficult because optimism is often still high while risks are simultaneously increasing. And historically, this is where many market participants become overly complacent. Okay, why? Because trends that have persisted for long periods begin feeling permanent. Okay, that's how they get you. Okay, when you become complacent, the markets turn on you and then you start losing money. Okay, structurally, people think that it is going up, but reality, this is often where markets begin most vulnerable to shifts in expectations. So positioning also plays a major role here. When investors become heavily positioned towards one direction, markets become increasingly sensitive to disappointment because there are fewer new buyers left to sustain momentum. And eventually, once liquidity tightens sufficiently or growth expectations begin weakening meaningfully, markets start transitioning into a different phase of the cycle. Now, importantly, these transitions are rarely immediate or obvious in real time. They often happen gradually beneath the surface before becoming fully visible later. And this is why understanding late cycle behavior matters so much because many major turning points begin not with dramatic headlines initially, but with subtle shifts in liquidity, positioning, and market sensitivity underneath the surface. Okay, so how central banks shape the cycle, let's look into this. This is a very simplified photo that I found. Okay, basically, whenever there's unstable economy, the government will step in through the central bank. The central bank will start implementing policies, monetary policies. It could be higher or lower interest rate. It could be giving out Okay, I'm here in Singapore, right? So in Singapore, we have this thing called the CDC voucher. So they give out these vouchers for you to use at supermarkets. Okay, this is the assistance that we get here in Singapore from the government. Okay, or they help you subsidize your school fees for families with kids, or they help you subsidize your electricity bill or whatever it is. Okay, so this is how governments will step in to help the people, okay, by implementing new monetary policies or by assisting. Okay, so once that happens, once the assistance steps in, we will start seeing stable and growing economy. Okay, so when we talk about market cycles, it is almost impossible to separate them from central banks because structurally, central banks sit at the center of modern financial systems. Their policy influence liquidity conditions, borrowing costs, credit creation, capital flows, and ultimately investor behavior across nearly every major asset class. Now, this does not mean central banks directly control markets perfectly. Markets remain influenced by many different forces. Growth, geopolitics, fiscal policy, sentiment, positioning, and global capital flows. But central bank policy heavily shapes the environment within which markets operate. And I think one of the biggest misconceptions people initially have is that market react only to actual policy decisions. In reality, markets are far more forward-looking than that. Very often, asset prices begin adjusting before central banks officially change anything. Okay, why? Because markets constantly attempt to price future expectations. For example, if investors believe a central bank may begin cutting interest rates several months ahead, markets often begin reacting immediately. Bond yields may move, currencies may adjust, and equities may reprice, and liquidity sensitive assets may start behaving differently even before policy changes occur. This is why communication itself becomes extremely important. Okay, central bank speeches, guidance, meeting minutes, inflation projections, and economic commentary all influence expectations continuously. And psychologically, markets are highly sensitive to changes in narrative. A slight shift in tone from a central bank can sometimes create significant movement across financial markets because participants immediately begin repricing future conditions. Another important point is that central banks influence cycle primarily through financial conditions. When policy becomes more accommodative, liquidity generally improves, borrowing costs will decline, okay? Since credit becomes easier to access and capital tends to flow more aggressively into risk assets. When policy tightens, the opposite gradually begins happening. Liquidity conditions become more restrictive, financing costs increase, and markets become more selective towards risk. Now, importantly, these effects do not occur instantly. There are often long delays between policy adjustments and full economic impact. But over time, these liquidity changes significantly shape broader market behavior. And structurally, this is why central banks remain one of the most important forces within modern macroeconomic cycles. Okay, so any questions so far? And I'm going to move on. No? Okay, so let's talk about how the interest rates affect the market. For those who are new here, especially if you really just started trading, I know this is a lot of information. Thank you so much. Ola Kunle. Sorry, I don't know if I'm pronouncing your name correctly, but yeah, if you are here for the first time, it is I know this is a lot of information to be absorbing, but let me tell you. So before I was invited by all these brokers to do these webinars for you guys, right? I was always focusing on technical analysis. So I would always neglect the bigger picture of the economy, right? So the bigger picture is understanding central bank, understanding interest rates, understanding fuel, how the fuel affects markets, understanding gold as per se. Okay, so I would trade a lot with technical analysis. And a lot of times when my trade ends up wrong, I have no idea why it's wrong. I will go back, I would review my trade, I would see where I went wrong. I don't understand what's going on. I'm using the moving average, I'm using the trend line, I'm using horizontal levels like I'm expected to when I watch all these videos or when I'm learning to trade with technical analysis. Yes, it works, but a lot of times it doesn't work as well. And you don't know why it doesn't work because if you don't understand the economy, you don't know why things are going against you. Not so much for Forex, but yes, in the market generally, you need to know how the market is working for you to understand why it is moving a certain way. Okay, so do keep coming for these topical webinars, right? IC Markets do 3 webinars. Like for today, I have 3 webinars with IC Markets. Right after this, I have a Bahasa webinar. So I'm actually Malaysian. Um, Bahasa webinar will be conducted purely in Bahasa. It will be right after this webinar. So you guys won't be able to attend that because you won't understand what I'm saying, right? But the next one will be the live analysis session, which is let me see. That is at 3:30 p.m. Singapore time. So it is 1:30 p.m. Singapore time right now. So in 2 hours, I will be doing a live analysis session where I show you how to use technical analysis, purely technical analysis. So every week, the 1 p.m. session is teaching you about the economy, about macro, micro economy, geopolitical tension, or whatever affects the economy, whatever moves the markets. Okay, but at 3:30, yeah, we focus purely on technical analysis and we don't focus anything to do with the economy. But the best part is if you learn both sides, how do I join? Please let me know. Um, does anyone know how to join the live analysis session? Again, I'm not actually from IC Markets. I am from a research firm. IC Markets invited us to do these webinars for you guys. So I have no idea. Let me send the link. Hold on. Okay, thank you, Nina. Thank you so much. Okay, so Nina is going to send the link over and you can join through that link. Thank you. See, I love when we have like a community going on and people are helping each other out. You, I know trading is a very solo career. I would say it's just you and the screens at the end of the day, but having a community will help you. Like you can ask, oh, where do I get the link? Oh, where do I learn this, right? So there's a lot of going on. Okay, I don't know. Can you see Nina's message? Nina has sent the link. I don't know if you can see it because sometimes they block. I'm not okay. It's okay. I'll just copy and paste. No, I'm only seeing my messages. Okay, there you go. Do you see the link that I just sent? Okay, thank you so much, Nina. Got it now. Okay, thank you so much, Nina, for the help. Thank you for sharing. Thank you for not being stingy with your information. There are people out there who's not willing to share. It's very weird to me, but yeah. Okay, so let's go on and understand how interest rates, I really appreciate. Yes, that is to Nina. How interest rates affect the market. Interest rates are one of the primary tools central banks use to influence economic activity and financial conditions. And while rate decisions may sometimes appear technical on the surface, their impact flows through almost every part of the financial systems. Okay, so at the most basic level, interest rates influence the cost of capital. When rates are low, borrowing becomes cheaper, right? Businesses can finance expansions more easily, consumers may spend more aggressively, and financial conditions generally become more supportive for economic growth. At the same time, lower rates also tend to encourage greater participation in risk assets. Why? Because when safer yields remain relatively low, investors often begin searching for higher returns elsewhere. So capital flows towards equities, higher yielding assets, emerging markets, and growth sensitive sectors. So liquidity circulates more freely through the system. Now, when central banks raise rates, the environment gradually begins changing. Borrowing costs increase, financing conditions tighten, credit growth may slow, consumer demand may weaken over time, and importantly, higher rates also affect valuation directly. In equity markets, future earnings become discounted more heavily under higher rate environments, which can place pressure on valuation, particularly for long duration growth assets. Currency are also heavily affected through interest rate differentials. If one country offers higher yields relative to another, capital may flow towards that currency because investors seek stronger returns. Okay, this is one reason why foreign exchange markets are so sensitive to central bank expectations. But then again, right, what matters most is often not current rates alone. It is relative expectations. Markets constantly compare where different economies and central banks are positioned within their respective cycles. Another important aspect is timing. The impact of higher rates does not always appear immediately. Economies and markets often continue performing relatively well during the early stages of tightening because liquidity conditions may still remain broadly supportive initially. But over time, tighter policy gradually begins slowing activity and increasing market sensitivity. And structurally, this delay affects is one reason why late cycle environments can become difficult to interpret in real time because surface level strength may continue while underlying liquidity conditions are already deteriorating underneath. Okay, so when interest rates, let's look at the picture together. When interest rates increase, okay, why does it increase? Why does the bank increase or decrease the interest rates? Sometimes they have to increase the interest rates because the economy is growing fast. Yes, you heard that right. Okay, so to slow things down, when things are going too fast, you will have consequences as well. But when things are going too slow, you will also have consequences. Therefore, they have to be in this very sweet spot where the economy is growing in a nice speed, at a nice constant speed where it's not too fast or it's too slow. Okay, so if it's going too fast, they will increase interest rates by a little or whatever it is, so that the spending decreases and stocks fall and bonds fall. They do this on purpose to keep a balance. Okay, there are consequences. We're not going to talk so much on what happens if the economy is growing too much in today's webinar because I still have a lot to cover today. But yes, there's reasons why they cannot let the economy grow too fast as well. They cannot let the economy slow down too much as well, because if it's slowing down, businesses will suffer, people will lose their jobs, yada, yada, yada. Okay, there's many things that will happen if the economy slows down. So what happens is they will decrease interest rates, spending will increase, stocks will rise, and bonds will rise as well. Okay? Okay, so beyond interest rates themselves, one of the most important drivers of modern market cycles is liquidity. And personally, I think liquidity is often one of the least understood forces among newer market participants because liquidity is often one of the most least understood forces among newer market participants because liquidity is not always directly visible the way the economic data or earnings reports are visible, but structurally, liquidity influences almost everything. When liquidity conditions are supportive, markets generally become more resilient, risk appetite improves, volatility tends to remain more stable, and capital becomes more willing to move in growth-sensitive assets. This is why periods of aggressive central bank accommodation often coincide with strong performance across equities and other risk assets. There is simply more capital circulating through the system. Now, when liquidity begins tightening, the environment gradually changes. Markets become less forgiving, sensitivity increases, financial conditions tighten, capital allocations becomes more selective, and more importantly, markets usually react before the broader economy fully reflects these changes. This is another very important principle in macro financial. Okay, financial markets are forward-looking. Okay, I say this a lot. Financial markets are forward-looking. They're always anticipating what is going to happen in the future. Investors constantly attempt to anticipate how liquidity conditions may evolve several months ahead rather than waiting for economic deterioration to become fully visible. This is why markets can sometimes decline even while economic data still appears relatively stable. They are responding not only to current conditions, but to changing expectations about future liquidity and growth. Another interesting aspect is that liquidity affects psychology. During highly liquid environments, confidence generally increases because downside volatility often remains contained for extended periods. Participants become more comfortable taking risks, but when liquidity tightens, emotional behavior changes quickly. Markets become more reactive to negative surprises, positioning becomes more unstable, volatility expands more aggressively, and this is often where markets transition accelerate. Because once liquidity conditions shift meaningfully, investor psychology tends to shift alongside them. Now, importantly, no single indicator perfectly measures liquidity conditions in real time. Traders often need to evaluate multiple factors together: interest rates, balance sheets, credit conditions, yield curves, funding markets, and broader risk sentiment. But structurally, understanding liquidity cycle is extremely important because they often shape the broader directions of financial markets over long period of time. And in many ways, liquidity acts as the underlying fuel behind much of modern market behavior. Okay. So let's understand positioning through different phases. Okay, guys, I didn't realize, I think I was spending too much time. Usually I'm almost done with the webinar with our slides, but as of right now, I'm only halfway through. So I'm gonna go a little faster for the next few slides. If you guys need me to slow down, just let me know in the chat box. If I'm talking too fast, let me know in the chat box because I still have quite a bit to cover, but we've only got 20 more minutes to go. Okay, so why positioning matters in the markets? One of the most important things to understand about financial markets is the price movements are not driven purely by fundamentals alone. They are also heavily influenced by positioning. And what I mean by positioning is how capital is already allocated within the system. This is extremely important because markets do not simply react to information itself. Markets react to information relative to existing expectations and positioning. For example, if most investors are already heavily bullish on the particular market, even positive news may have limited impact because much of the buying has already occurred. On the other hand, if positioning is heavily defensive and conditions begin improving slightly, markets can rally very aggressively because capital starts rotating back in rapidly. So structurally, positioning acts almost like pressure within the system. And this is why markets sometimes behave in ways that initially seem irrational. A strong economic support may fail to move markets higher because expectations were already extremely optimistic. Conversely, weak news may produce limited downside if pessimism was already heavily priced in. This is one reason why understanding sentiment and positioning becomes so important in macro and analysis, because financial markets are forward-looking mechanisms. By the time headlines become obvious publicly, positionings may already reflect those expectations significantly. Another important point is that crowded positioning creates fragility. When too many participants are positioned Similarly, markets become vulnerable to sharp reversals because even small changes in expectations can trigger large repositioning flows. And psychologically, this creates feedback loops. Strong trends attract more participation. Increased participation strengthens strength further. Confidence rises. Positioning becomes increasingly concentrated. But eventually, once positioning becomes overly one-sided, markets often become much more sensitive to disappointment. This is why experienced traders and macro participants they pay close attention not only to fundamentals, but also how markets are positioned relative to those fundamentals. Because sometimes price movements are driven less by news itself, but more by how much the news already expected and priced into positioning beforehand. Okay, so institutional positioning um, tends to evolve gradually throughout different phases of the market cycle. And I think this is important because institutions generally think very different compared to short-term retail traders. Large institutions, whether hedge funds, pension funds, sovereign wealth funds or asset managers usually manage extremely large pools of capital. Because of this, they cannot enter the or exit. They cannot enter or exit instantly without affecting prices significantly. So positioning often changes progressively over time rather than all at once. Okay, so during early cycle environments, when liquidity conditions improve and growth expectations recover, institutions generally become more constructive towards risk assets. Capital begins rotating into equities, growth sectors, emerging markets, higher beta assets, and cyclical industries that tend to benefit from improving economic activity. Okay, why? Because in supportive liquidity environments, investors are generally rewarded for taking more risk. Confidence improves gradually as financial conditions stabilize and growth expectations strengthen. Now, as the cycle matures, institutional behavior often becomes more selective. Positioning may still remain constructive overall, but capital allocation starts becoming more cautious beneath the surface. Institutions may begin reducing exposure to weaker areas of the market while concentrating more heavily in sectors perceived as more resilient. So this is often where markets' breadth starts narrowing. Late cycle environment frequently involved in smaller number of assets continue to drive headlines market strength while underlying participation weakens gradually. And eventually, when liquidity tightens more meaningfully or macro risk increase, positioning becomes increasingly defensive. So institutions may rotate towards safer assets, increase cash allocation, reduce leverage, or favor more defensive sectors and currencies. Another important point is that the institutions constantly evaluate relative opportunities. Markets are global and interconnected. So capital flows towards regions or asset classes offering the most attractive combination of growth, liquidity, yield, and stability. Okay, this is why positioning shifts can sometimes create major market trends even without dramatic headlines, because gradual institutional reallocation involves enormous amounts of capital moving across the system over time. We're talking about billions of dollars, okay? Billions and billions of dollars. And structurally, understanding these flows help explains why trends often persist much longer than people initially expect. Okay, so let's look at how positioning creates market extremes. One of the most, at least in my opinion, is aspects of financial markets is how positioning can eventually create extremes in both directions. And psychologically, this is deeply connected to human behavior. During strong bull market, confidence gradually increase over time. Investors become more comfortable taking risks because markets repeatedly reward the behavior. As prices continue rising, more participants enter, capital flows accelerate, leverage may increase, narratives become increasingly optimistic, and eventually optimism itself becomes part of the trend. So now, importantly, This does not necessarily mean the trend is immediately wrong. Markets can remain strongly positioned in one direction for a very, very long time, but structurally, more crowded positioning becomes, the more sensitive the market eventually becomes to disappointment. Because once positioning becomes heavily one-sided, there are fewer new participants left to continue driving the momentum up sustainably. You know what I mean? Because there's so many people already in the market that they cannot push the price higher. Okay, for example, so at that stage, even relatively small shifts in expectations can trigger disproportionately large reactions. The same process occurs in reverse during highly negative environments. During periods of panic or uncertainty, participants often become excessively defensive. Capital asset exits risk assets aggressively, volatility rises sharply, and pessimism becomes widespread. But eventually, positioning can become so negative that markets begin stabilizing even before headlines improve significantly. Why? Because markets move at the margin. At most, sellers have already sold, downside pressure naturally begins weakening, and this is why reversals often begin quietly. At major turning points, the headlines usually still appear negative, while price behavior underneath the surface starts stabilizing gradually. Okay. So let's go into our very last part of today, which is recognizing when a trend is ending. This is very important, okay, guys. I have so much to talk about trend exhaustion, but I've only got 12 more minutes with you guys, and I don't even know if I can talk. I can finish the little bit I'm going to talk. So this is very important. If you can master spotting trend exhaustion, I can guarantee you will make a lot of money from the markets. Okay. So it is one of the most difficult things in the financial markets, okay, is to recognize when the trend is exhausting and when it is weakening. Okay, why is it so hard to recognize? Because people are very emotional. People are always living in denial. People don't want to accept that the trend is ending. And I think this is difficult because strong trends naturally create emotional conviction over time. When markets trend consistently for long periods, participants gradually begin assuming the trend itself is permanent, which is impossible. Nothing is ever permanent in the market. The market is constantly moving in a zigzag pattern, right? So optimism strengthens during bull market, while pessimism deepens during bearish environments. But structurally, all trends eventually begin losing momentum. And importantly, trends rally and suddenly without warning beneath the surface. So when I was trading purely on technical analysis, I always like, hey, why is the market going against me? Why is it reversing? Why is it doing this and that, doing this and that? Okay, but the markets are never doing it randomly. There's always a reason to why there is a trend exhaustion, or maybe even just a pullback or whatever it is. There is always a logical and economic reason to it. So usually there are gradual shifts happening internally before the broader reversal becomes fully visible. At the center of a very sustained trend is several major supporting forces: liquidity, positioning, macro expectations, and capital flows. So as long as these forces remain aligned, trends can persist for surprisingly long periods. But eventually, one or more of these drivers begin changing, and then you start to see the shift happening. Okay, again, I cannot go too in-depth specifically on trend exhaustion. If you want to talk about trend exhaustion, I can talk about trend exhaustion for hours and hours. But because we don't have a lot of time, I'm gonna have to like sum it down for you guys. Okay. So one of the most useful ways to identify potential trend exhaustion is by observing internal market behavior rather than focusing on price itself. Okay, this is just one example where there's diversion and diversion is showing. Okay. Because price can sometimes remain strong even while internal conditions are gradually deteriorating underneath the surface. And this happens quite often during late stage market environment. One major sign is weakening breadth. Okay. In healthy trends, participation tends to be broad. Multiple sectors, assets, and market components generally move together constructively. But as trend mature, leadership often narrows. Fewer assets continue driving overall momentum while broader participation weakens gradually beneath the surface. For example, headlines indices may continue rising while an increasing number of stocks internally beginning to underperform. Okay, this divergence often signal that momentum is becoming less structurally healthy, and another important sign is changing volatility behavior. During strong trending environments, markets usually absorb negative news relatively smoothly. Pullbacks remain controlled and volatility tends to stabilize quickly. Okay, but when trends begin weakening, volatility reactions often become more aggressive. Markets may suddenly react much more sharply to relatively minor disappointments. Why? Because positioning and confidence are becoming more fragile underneath. Another major signal involves momentum divergence itself. Sometimes markets continue making new highs, but momentum indicators, volume participations, and relative strength begins to weaken progressively. Okay, please take note that divergence alone do not automatically mean immediate reversal. Okay, it is just a early stage indication. Markets can remain extended for a very, very long period of time, longer than people expect it to. Okay, but structurally, these signals often indicate that the underlying strength supporting the trend is gradually weakening. So psychology also changes subtle during these environments. So instead of markets moving smoothly higher, price action often becomes more unstable and emotionally reactive. Sudden sharp reversals become more common, positioning becomes increasingly sensitive. Okay. So let's go into our very last part for today, and then if I can finish this in a few minutes, we can have a little Q&A session if you guys have any questions for me. If not, start throwing your questions in the chat box. Okay, so when major trends begin reversing, the process is usually less about a single event and more about a broader shift in expectations. And structurally, this transition often begins quietly. Initially, markets may simply stop responding positively to good news. Momentum slows, reaction becomes less constructive, and internal divergences expand. Okay, at this stage, many participants still assume the existing trend will continue because recent performance remains psychologically dominant. But underneath the surface, liquidity conditions are often already changing. This is extremely important. Major market turning points are usually connected to shifts in liquidity, growth expectations, or central bank policy. So, for example, during bullish late cycle environments, tighter financial conditions may gradually begin reducing liquidity support. Credit becomes less accommodative, volatility sensitivity rises, positioning becomes increasingly fragile. Initially, these pressures may appear manageable, but eventually, once expectations begin shifting meaningfully, repositioning accelerates, and this is where volatility often expands sharply. Why? Because once crowded positioning begins unwinding, price movements are no longer driven purely by fundamentals. They become driven by forced repositioning, emotional reactions, and liquidity imbalances. This is why market reversals can sometimes appear surprisingly aggressive rather after long periods of stability. Another important aspect is timing. Reversals are rarely fully visible in real time. At major turning points, narratives from the previous trends often remain dominant psychologically, but during bullish peaks, optimism is usually still widespread. During bearish lows, pessimism often remains deeply entrenched, but markets begin changing before consensus fully adapt. Okay, so this is why experienced macro participants focus heavily on expectations, liquidity, rather than reacting on headlines alone. Okay, because trends usually end up when everyone recognizes weakness and when the underlying driver supporting the trend begins deteriorating beneath the surface. So ultimately, understanding trend endings is not about predicting exact tops or bottoms perfectly. It is about recognizing when conditions are changing structurally. And I think this perspective is extremely important Okay, because it shifts market analysis away from emotional reaction and towards understanding how liquidity, positioning, expectations, and macro conditions interact across the broader financial markets. Okay, so do you guys have any question from I got one question already. Okay, so someone is asking why do markets sometimes rally even when the data is looking weak? Okay, again, like I said this many, many about our webinars, because the financial markets are forward-looking, right? So investors, sometimes you see the news coming out bad and the market's going the other opposite direction, or you see news coming out good, but the market is still dropping. Because investors often begin pricing future recovery expectations before improvements is fully visible in the actual economy. So markets tend to move ahead of economic data rather than reacting only to current conditions. Okay? Okay, so I don't really see any other questions. If you guys have it, ask me in the chat box. Otherwise, I'm gonna stay here for a few more minutes and then I will answer you. Do not be shy, guys. Just ask me in the chat box. Okay, so Nina's asking, can I request market cycle with Wyckoff application next time during technical analysis? Yes, for sure. So not for today because I'm not exactly very ready, right? I do when it comes to Wyckoff, I think I do need to spend a little bit more time on analyzing the market. So why, when you join my live analysis session, you see me constantly using that cheat sheet because the cheat sheet is the most, I think, in my opinion, is the most straightforward, easiest way to do analysis on the markets, even for beginners. Because you need to know that sometimes in our webinars, we have beginners, like very, very new people in the market. So that's the easiest for everyone to understand. That's why I use that. But if there is a request, I definitely will follow the request. Let us say it is like applied. Okay, yeah. So I will do YCOP application next Tuesday, which is on the 19th, but not for today's live analysis session. Hope you're okay with that. Okay, guys, I don't see more questions. Testing. Catch you later. I don't see more questions, so I gotta go so that I can 3:30 Singapore time. So 1 hour, 1.5 hours from now. 3:30 p.m. Singapore time. Okay, so I will catch you guys again in 1.5 hours for those who are joining. I gotta go prepare for my next webinar, the Bahasa webinar. Okay, so I'll catch you guys later for the English webinar. Bye, guys. Take care. See you again.